getting started for both? Stocks going down, rates going up? What do you mean?
Of course. And as your previous panel said, Scott, none of this should have been a surprise. What we've chosen to do, and by us, I mean the vast majority of us, and why there's a disconnect between the market and what the Fed intends to do, is Joe hit this right on the head. We can't separate what we want from what the data actually tells us. And so when we saw that 500,000 jobs number for January and we saw that PCE come in hot, this should have been largely predictable. Why the Fed futures continue to discount this, I do not know. But what I do know is we can continue to look at this from a very myopic perspective and have a negative surprise every 2 months, or we can take a longer term view of this, as you know I have, Scott, and I've been at a 6.5% terminal rate for the last 3 months. And if what we want to do is every 2 months raise it by 25 basis points until we all get there, then I guess that's what we'll do, but it'll be a painful ride.
Well, you really think we're going to get that high? I mean, I know it's nice to throw out a hyperbolic number like 6 or 6.5, but I mean, that honestly sounds a little bit extreme, doesn't it?
Does it sound extreme? At the end of the day, we've seen Fed funds rates in the double digits. I mean, is it extreme compared to free money? Of course. And this is part of our problem, Scott, is that we're thinking about this from a prisoner of the moment complex. Is 4.5% unemployment really disastrous? I know the politicians will take that red meat to their base, but at the end of the day, the average for the U.S. from 1948 to 2023 is north of 5%. And so we've got to stop focusing on 6.5 or 7 or whatever it's going to be being this disastrous number when in reality it's just not.
I mean, easy for us to say, when millions of people are potentially losing their jobs as a result. Easy for us to sit back and suggest that it's not that big of an issue. Ed Yardeni's joining us for the conversation now. Yeah, go ahead.
Do you know what the bigger issue is? The bigger issue is that we're going into a period in a few short months where we'll have had single-digit inflation year on top of year on top of year, starting mid-2021. So something that cost $1 in 2021 is now going to cost $1.25. And while that doesn't hurt at the upper socioeconomic spectrum, at the bottom, that is life-changing. And we have heard that from the retailers this week as they told us that their shoppers are moving away from discretionary big-ticket items. So I think that that's a little bit more important that an average family of four is feeling that type of crunch.